After what's happened over the past few months, I can quite understand why you think there's every reason why you shouldn't actually invest. Somehow the mattress takes on a whole new level of interest for keeping your money. But Tom, that's probably a bad idea.
Well, it depends what your time horizons for investing are. If you need the money in 1 or 2 or 3 or 4 years, then leaving your money in cash or cash-like instruments or guaranteed instruments is a perfectly sensible thing to do. Over the longer run, however, if you were to leave your money in cash, it tends to lose its purchasing power. So in the longer term arena, probably not a great thing to do, and you probably should be invested.
But you see all the headlines in the newspapers every day, and they're warning about the stock market going up and down and worries about gilts and things like that. Why should people want to put their money into something which is ostensibly seems riskier?
There was a fellow American of mine called Mr. Buffett, and Mr. Buffett would be the first to tell you that when markets are looking shaky and people are afraid, then that's probably a good time to invest with a longer term view. It's when markets are at the top and everybody's happy that he gets a little bit worried. So we're certainly not at the top at the moment. Nobody's happy at the moment. And Mr. Buffett would probably be putting all of his money to work right now.
Yeah, but even so, it's still very volatile, though, isn't it? Is there anything we can try and do to give people a bit more confidence that actually it's not just going to be a bet on some share going up and down?
Yeah, and that plays to the way that we manage the money. What we do at 7IM is we produce different levels of risk, and for each level of risk, we have very, very broadly diversified portfolios, so different kinds of investments. We call them asset classes or regions and manager styles. And the purpose of diversifying the portfolio is to limit that volatility in the portfolio, that risk. And also, to increase the probability that the expected outcome is what happens over the longer term.
Okay, but if it's not shares and government gilts, what else? What other sort of things could you invest in?
Well, first of all, we do invest in shares, but we invest in funds. So we invest in UK equities and European equities and Japanese equities and North American and emerging markets and large caps and small caps and medium caps, but also fixed interest, and very wide range of fixed interest instruments. So it could be gilts, it could be other governments, it could be corporates, it could be junk, it could be index linked, property, commodities, currencies, cash, commodity trading advisors. There's a very wide range of things that all sound a little bit scary, some of them, but when you put them together, it actually has the impact of lowering the risk in the portfolio.
And this doesn't sound like the sort of thing you find in a normal retail fund or portfolio.
It's actually drawn from the corporate pension world. So the largest corporate pensions are managed in this way with this very broad diversification. And the reason that they do that is these corporate plans have a long-term view.
Right.
And what they want, because they have certain memberships members that will be withdrawing every year, they need some predictability as to what the outcomes are going to be. So the longer term view, the more predictable outcomes suit the pension world, and I think, and you think, that they probably suit most individuals.
But that's all very well if I've got a pension, but if I've got an ISA, a small amount I want to put in that, is that really suitable for something as small as that? You're talking about large sums of money, aren't you?
Most people these days, we find, are using their ISAs for longer-term savings. Right. So if you're using your ISA for a very short-term saving, this is probably not appropriate. If you're using your ISA for 4 or 5 years plus savings, then we think it is. Okay,
one last thing then. But all these investments we've seen over the past few years, people have been worried about some of the costs, not just the costs they can see, but also worried about some of the hidden costs that come out a bit later. How can we address that?
We've majored in trying to reduce the cost because in the world that we're looking at, cost has become very, very important to the success of the portfolio. Simply stated, if you have lower cost, your investment performance is going to be better because there'll be less that gets deducted from it. What we have done is after we've chosen these various asset classes, you can either buy what they call an active manager, which tries to beat a particular index, or you can buy a passive instrument, which tries to replicate that index. The latter, the passives, tend to be much, much less costly than the active managers. So to fulfill the asset classes that we have, we use passive instruments in our asset allocated passives or AAP portfolios.
So let's put this together. You need to look at something which is 3 to 5 years in terms of investment length.
At least.
Right. Okay, you're going to have a range of different risk profiles to work out whether you're feeling a bit more cautious or a bit more adventurous.
Yep, 4 risk profiles.
Okay, and then broadly spread like an institutional investment structure?
Yes, very broadly spread for the purpose of having a higher probability of achieving what we expect it to do, which would be about 6 or 7% in a balanced portfolio over the course of time per year.
So a greater level of predictability, and then trying to strip out as much of the extra cost as possible.
Indeed.
Okay, that sounds like pretty good value. Well, put it this way, leaving your money under the mattress probably doesn't help very much. After all, your mattress can catch fire. Whereas actually investing for the medium term, you're spreading your risks and not just spreading on a mattress. Goodbye.
Thank you.